look at that import waiver, which begins today. Interesting. And we have joining us to discuss on our commodity segments now, Dumebi Oluwole, senior analyst with financial derivatives. Hi, Dumebi. Good morning. Second time this week.
Yes, happy to be here.
So I mean, the import waiver that the federal government talked about begins today.
Yes.
But we always talk about the lag, you know, when it comes to policy.
Yeah.
So I wonder how long you think it will take before we start feeling the effects in the market. They said it's going to end by December 31st.
I would say this is not so much the case where you would have that kind of long lag effect between policy and implementation, simply because this is exactly what it is. You're going to buy, you're going to get your products at a very subsidized, at somewhat like a subsidized rate.
Yeah, but you know the traders already have old stock.
Yes, so that's where I was going to. So by the time they're selling that off, then we're going to definitely see that prices might still remain high up until maybe, because it's starting today. So let's say for about a month, and then we will now start seeing reduced prices. And besides, remember on Tuesday we already started seeing that some prices for some commodities were already declining, just simply because we're seeing some increase in supply. And remember that this import waiver is coinciding with the harvest season as well. So the combined impact of that on the food market might likely be very positive going forward. And then when you look at the impact of this on the broader headline inflation numbers, you see that we do expect inflation in subsequent months to somewhat taper, simply because base effects are also going to have an added positive impact on the headline inflation rate. But to be very clear on how this would translate in the economy, so already we're seeing that yes, prices are reducing, but then again you have to consider the fact that are people really equipped now to, with their income levels, are they equipped to purchase, the commodities? So we do expect that in the upcoming months, people will definitely plan. It's not a situation where there's panic buying now, where you have to buy when prices are completely reduced. But this doesn't look like it's going to be very good for the farmers, because eventually, when the market is flooded, then the farmers will be forced to reduce the price, and they also have to plan for the future. This is ending in December. I mean, so this is it. We tend not to look at a lot of situations like this in that regard, because it's like, think of it at a time where it's like crunch time, right? Where everybody is coming together to ensure that there is some level of price stability, especially for food in the country. So farmers right now, they're already harvesting, they're selling, they will obviously sell their products. This is one of the situations where we do expect marketers to leverage on volume of sales rather than the pricing in itself, because when prices are reduced and you're able to sell at a larger quantity, you should be able to somewhat net it off. And again, this is also coinciding to an extent with the fact that petrol prices, so their logistics costs, petrol prices and diesel prices are not exactly as exorbitant as some months back. So we do expect that would a little bit reduce the operating expenses on distribution and logistics as well. So the combined impact of all of this over the next couple of months will be somewhat positive. I
wonder what will happen after December, though.
Again, obviously these are policies that have to be reviewed to see the impact, and this is where one of the conversations about implementation and execution comes to place. So when we enact policies like this, and we obviously see how the markets are receptive towards it, and we see how impactful it is in this kind of economic times that we're in, where we need to ensure that there's somewhat like food security and social tensions are not high. So this is something that we do expect should be sustained at least up until when the reforms start phasing out a bit.
Yeah, I hope we would have at the background, while we're enjoying this, we're having a longer term, for instance, dealing with the issue of insecurity, so the farmers can get back and and all of that. So by the time this is waning off, then we have the supply from there. But today is inflation day.
Yes.
What's FDC seeing?
I mean, we do expect that inflation would still, somewhat increase, but the rate of increase will be lower. And this is because of what exactly happened in the month of July compared to what is happening right now. So in the month of July, we saw the Naira depreciate a bit more, and that obviously would have an impact on importation costs and then prices. We also still saw a lot of commodity prices increase significantly. In July, the prices of tomatoes were really high, pepper was really high, onions was really high, rice as well, and we do expect that to have an impact on the inflation numbers. And what is extremely important to note is when the NBS goes out to actually collect the data and analyze, they actually do this within the first 2 weeks of the month, of the of the period. So meaning that this survey, the numbers we're going to see are actually what happened within the first 2 weeks or first 3 weeks of July. And within those periods, that's when we saw all of these things happen.
Well, I think then we can expect good numbers by the end of August, because we're beginning August on good notes. We have the harvest, we have the tomatoes and pepper. Now we have the import waiver coming into that. So definitely a bit of stability after the protest and all of that.
Definitely. So, but one thing to just note is the rate of increase in inflation rate. So while the number might look higher, we also consider on another layer of analysis the rate of increase in inflation. And when you look at what has been happening from the beginning of the year up until June, you see that the rate of increase in inflation rate has actually slowed down. So we're coming from a period where the rate of increase in inflation as of February and March was around 1.5 percentage points, and as of June, even when inflation actually increased to 34.19%, we saw the rate of increase significantly decline to 0.2%. So we do expect that the rate of increase would decline again, but the number will just be a little bit higher than what
I mean, we look forward to when we do like US yesterday. They're even below the target now. Their target is 3%, or they did 2.9. Unlike the UK, though, UK had a little bit of increase. But I mean, I think this puts us for the US on the path to rate cuts, which we are hoping for.
So definitely. Just when you look at the temperature of the global inflation and interest rate environment, you do see the same pattern coming up from the US spread, from the Bank of England, from the European Central Bank, even the Bank of Canada as well. You see that almost everyone right now is, easing their tightening measures because price pressures are already, abating. For Nigeria, the situation is not yet the case. But we did ease,
anyways. We did just 50.
I mean,
50 basis points increase. Compared to what we've done before now.
Yeah, definitely. But one thing, I think I mentioned this on Tuesday. One thing we need to understand is how the central bank monitors inflation and how that drives the decision that they make. So they're not only looking at the headline inflation number. Most central banks look at the underlying inflation rate. That's the core inflation rate. And when you look at the core inflation rate in Nigeria over the past months, you see that has steadily increased, even faster than the rate of increase in the headline inflation rate. So what does that tell us? It tells us that the underlying things that are causing inflation to rise in Nigeria are still very prominent. So things like the exchange rate volatility, things like low agricultural sector productivity. And that now brings me to the point where you already mentioned before that, aside from these short-term measures, we need to have long-term measures in place. But again, with the levers that the monetary policy authorities can pull, they basically just have interest rates and their other monetary policy tools.
We look the way of fiscal.
Yes, right now, that's the way to look.
All right, Dumebi, thank you so much for your analysis this morning.
Thank you so much for having me. You too.